the probability of taking big winners. And I wish more traders would talk about this, talk about the raw statistics about taking big winners, okay? Because what you're going to see, hopefully, and what you're going to understand, hopefully, by the end of this topic, is that trading is not about taking big winners. Trading is about being consistent. And when the market presents you with a big winner, which is infrequent, it's low probability, but when it presents you with it, you need to capitalize on as much of it as possible, okay? But by and large, the job of a trader is, guess what? It's to take the boring 1-to-1 trade opportunities. It's to take the 2-to-1s and the 1.1-to-1s and the 0.5-to-1s. That's the job of a trader, okay? The point is that if you are thinking about trading as a 2-to-1 and a 5-to-1 as a 10-to-1, this mental model approach to strategy development is simply not grounded in statistical facts. Okay, in other words, what I'm trying to say to you is, if this is your mindset, if this is how you view strategy development, you're starting off at the wrong approach, because you're going to approach your back tests with this viewpoint that strategies need to have 2-to-1, 5-to-1, 6-to-1 to be good. They don't. Okay. What strategies need to be good is they need a lot of frequency. That's, if you go build any back test, frequency is good. Okay, lots of opportunities is good, because that reduces volatility in the equity curve. What you also need is not necessarily a high win rate, but you need a good win rate relative to the stop versus target. Okay, it's the ratio between those two that matters. Okay, so make sure when you start thinking about your trade strategies, don't be sucked into this idea that trade strategy needs a high risk to reward. It doesn't. Okay, so the truth is your win rate is lower than you think. Okay, I think most traders are blinded, overconfident about their win rates. Your win rate's a lot lower than you think, and your real risk reward is substantially lower than what you think. Okay, in a minute, I'm going to show you, something from the Tradelo application that'll kind of drive this point home. Now, what you can see in this chart, there is an inverse relationship between the size of your targets and the probability the market offers them. Okay, the greater the target, so on the y-axis, we've got the probability of the target being reached. Okay, on the x-axis, we've got the target size. So how big a win are you going for? Okay, and there is an inverse relationship between the size of your target and how often the market's going to offer those to you. Okay, the greater the target, the less likely the market will offer this opportunity. Moreover, the greater the target, the lower the potential profitability. Okay, if you're always looking for really big winners, and often I talk to traders about how to develop your targets, how to understand where to get out of trades. The reality is, if you're always looking for big winners that are happening infrequently, guess what? You're going to watch so many trades come back. You're going to be seeing so many of your winners come back to entry or even stop. Okay, so ultimately, you have to understand what is feasible, what is likely, what's high probability. Okay, and this is not about having the highest probability for the least number of ticks. Okay, it's not about pick this spot on the curve because 90% of the time you're going to get 2 ticks. No, because the reality is you have to use a certain stop size to achieve those 2 ticks. Right? It's about finding that balance point. Where is that high probability that I'm going to get a sufficient amount of ticks in terms of targets that will equate to a decent amount of net profit? Okay. One thing I will say, by the way, when it comes to backtesting, it's not about this. You're not going to look at it and go, oh, that's the exact one I need to use. No, it is going to be, I think it's somewhere between here and there. And what I would always say to traders, err on the side of caution. Always be conservative. Always allow for slightly smaller stops and equally smaller targets. Why? Because remember what I said to you. If we draw this thing called a distribution and we look at the targets, we'll see most of our targets will fall between, let's say, 10 and 20 prices. And, anything between that is an outlier. Okay, so always err on the side of conservatism because you're more likely to achieve those outcomes. Okay, that was theory. This is reality. This is what a real backtest profile will look like. Okay, now what you've got here, on your x-axis, you've got your target threshold. Think of this as how big my winner can be hypothetically. Okay, on the left-hand side, we've got something called the marginal gain-loss ratio. I'll explain that to you in a minute. On the right-hand side, we've got net profitable. Okay, so what percentage of my trades are profitable? Okay, so we can see the red line, as we increase the target, what does my net number of profitability trades do? Okay, so in other words, how many winners do I have effectively? And we can see that drops off from around 48% all the way down to 36%. Okay, so it goes without saying, if you target a bigger target, the reality is you're going to have less winners. Okay, makes sense. However, that's not the only thing you need to consider. The other thing you have to consider is ultimately what we call the marginal gain loss ratio. And the way to think about this is when you increase your target, what happens ultimately is some of your trades, because you're increasing the target, are not going to quite get to that target. So instead of being a winner, what they end up becoming is a loser. Okay. And what we look at in terms of this ratio is we're trying to understand, as I'm increasing my target size, what's my ratio between the number of winners I'll have in the strategy versus losers doing? Because what we don't want to do is we don't want to see this ratio significantly drop off. Now, and this is a little bit misleading because of the scale. I know it looks like a significant drop off. But in essence, what this is showing me is for every winner I have, how many losers do I have? Okay. So think of it as a win rate. It's nothing other than a win rate. I'm having, in this example, 2.2 winners for every loser. Okay. And what we can see is as I increase this target, what happens to that ratio? We can see suddenly it comes down to 2. Suddenly it comes down to 1.8. Suddenly it comes down to 1.6. Okay. So I have 1.6 winners for every loser. All right. Now, again, the same as previously. It's not about picking that point. It's not about picking that point. It's about picking that point where you've got a little bit more of a target, but equally you're not seeing too substantial drop off in your ratio of winners to losers. Okay. And this is what it's all about, guys. This is, picking a target is not, I know too many traders fixate on, it should go, yeah, it should go there. No, it shouldn't. Just run a back test and go and have a look what's feasible. Go look what that favorable excursion looks like and plot it. Okay. And then just go pick statistically what's likely to happen. Right? It is as simple as that. That's what trading is. It's just about understanding, what does that excursion look like? How can I partake in that excursion? What should I be looking at more or less in terms of target? And where should my stop go roughly? And does it make sense? Does it make sense for me to take this trade or not? If I do this 100 times, will I make money or not? That is trading. It's a game of accepting that you're going to lose, and it's a game of capitalizing when you win. All right, let's go on. Now, okay, so at Tradelo, we have 2 proprietary statistics that we keep track of. Okay, and I think these are very important statistics because they really do keep traders grounded in reality. We call one the effective win rate. Okay, so most of you know a win rate, a normal win rate. You talk about your trades as winning, 50, 60, 70% of the time. Okay, that's rubbish. All right. A win rate for a trader should be, how often do you win more than you risk? Okay, very, very important. If I risk $100, how often do I make $100 or more dollars? That's a win rate. Why? Because think about it. If you typically just look at a normal win rate and you win $1, but you risk $100 every time, the reality is your win rate's absolutely meaningless. It's a pointless statistic. And too many platforms will show you the statistic. Why? Because it's sexy. Because, hey, it sounds good. I'm winning 60% of the time. Okay. We look at effective win rate. What we care about is something that actually means something. How often do I win more than I risk? Okay. Now, what you're going to find is, yes, look at any Tradelo trader's profile. You're going to look and you go, well, this guy must be a rubbish trader. He only wins 16% of the time on this trade strategy. Okay. The reality is the effective win rate on this is that 16% of the time, this trade wins more than it risks. Okay. Now, the other trade statistic that we look at is what we call real risk reward. Okay. Again, most traders look at hypothetical risk reward. What they do is they go do a back test and they go, okay, I get 1.77% risk reward. The reality is that a real risk reward, and the difference between a real risk reward and a normal risk reward, is a real risk reward only factors in actual outcomes. In other words, the trade you do tomorrow, I'll count the risk reward for that one. And the trade you do after that, I'll count the risk reward for that one. Why? Because what traders typically do when they develop a strategy, they say, oh, I'm going to take 2-to-1 risk reward. I'm going to take 5-to-1 risk reward, and that's a good strategy. In reality, what they do is they take 1-to-1 risk reward. They take 1.2-to-1 risk reward. Okay. So when we look at real risk reward like this, we stop wasting our time in hypothetical land. We stop wasting our time, looking at statistics that just make us feel good. And we look at what our statistics actually say. My strategy has got a 1.87 risk reward. That's what I actually make on this trade strategy. Okay, and that's really, really key, because when we're looking at real statistics that actually really mean something, we can then start to be objective and say, do we have edge, or are we just wasting our time here, guys? Okay, so my key drive home message today is stop looking at wasted time statistics. A lot of these platforms are showing you a lot of statistics and a lot of noise. Start using those statistics like the MAE and MFE, like the effective win rate, start using those statistics in the right way so they can actually tell you something that can add value to you as a trader.